let me tell you something the market taught me the hard way. The entry that looks perfect is often the one designed to take your money. I have seen more traders ruined by beautiful looking setups than by ugly ones. Strange, isn't it? You would think the cleaner the chart, the safer the trade. But the market does not reward what looks obvious. It rewards what is right, and the two are rarely the same thing. You've seen it yourself, haven't you? Price pulls back neatly to support. The candles line up like soldiers. Momentum indicators turn at just the right moment. Everything looks so precisely, so clean, so certain. And right there, your finger starts to itch over the buy button. That, my friend, is what I call the perfect entry trap. Now listen carefully. The market has a habit, a very expensive habit, of punishing the crowd at the point of maximum comfort. When a trade looks too perfect, too easy, too widely visible, you must pause and ask yourself a simple question. Who is on the other side of this trade? Because every time you buy, someone smarter, or at least better positioned, is selling to you. In my years watching tape, I learned that the most dangerous moment for a trader is not confusion. No, confusion keeps you cautious. The dangerous moment is confidence, especially the kind that comes too quickly. Have you ever noticed how the perfect entry often gives you just enough profit to feel clever before it turns and walks straight through your stop? Of course you have. We all have. You see, the market knows where traders like to enter. It knows where they place their stops. Price does not move randomly. It moves where the orders are. And when thousands of traders spot the same textbook setup, what do you think happens to liquidity? It pools. And where liquidity pools, professionals hunt. This is not conspiracy. It is mechanics. When a chart forms what looks like the cleanest breakout or the prettiest pullback, what you are often seeing is not opportunity but advertisement. The market is inviting the crowd in so that stronger hands can do business. Now don't misunderstand me. I am not telling you to avoid good-looking setups altogether. That would be foolish. What I am telling you is this: never trust perfection at first glance. The market rarely pays the impatient eye. In my own trading, I learned that the best entries often feel slightly uncomfortable. Not reckless, mind you, but not obvious either. There is usually some doubt in the air, some hesitation in the tape, some friction in the move. Have you noticed that the moves that truly run often begin when most traders are still arguing with themselves? That is no accident. The crowd likes certainty. The market offers probability, and the man who confuses the two will find his capital steadily migrating into other pockets. Let us talk about the psychology behind this trap, because that is where the real danger lies. When you see a setup that looks perfect, something happens inside you. Your brain begins to calculate the profit before the trade even triggers. You start to picture the clean move, the easy gain, the smooth ride upward. And right there, before you have risked a single dollar, your objectivity begins to leak. That is the moment discipline must step in, because the market does not care about how pretty your entry looks. It does not reward neat trend lines or textbook pullbacks simply because they are neat. The only thing the market responds to is order flow and imbalance. And imbalance rarely looks perfect to the untrained eye. Let me ask you something. How many times have you entered the cleanest breakout, only to watch price poke above the level, trigger your entry, and then sink back like a stone in water? That little move has a name among professionals. It is the shakeout, the stop run, the liquidity grab. Call it what you like. The effect is the same. Weak hands get pulled in at the worst possible price. And here is the cruel part. Most traders respond by tightening their rules, drawing cleaner lines, searching for even more perfect entries. They think the solution is precision. But trading is not surgery. It is speculation. Precision helps, but only when paired with patience and context. The seasoned operator learns to ask different questions. Not, does this look perfect? But rather, who is likely trapped here? Where are the stops clustered? Is this move attracting the crowd or exhausting it? These questions will save you more money than any indicator ever printed. You see, wealth in trading does not come from being first into every move. It comes from being selective, from waiting for the moment when risk is clearly defined and the crowd is leaning the wrong way. That requires something most traders lack: restraint. The amateur wants action. The professional wants position. There is a difference, and it shows up very clearly around these so-called perfect entries. I learned long ago that money is not made by trading often. It is made by trading well, and trading well frequently means letting the obvious trade go without you. Painful, isn't it? To watch a move run without you after you passed on it. Your ego protests. Your fingers twitch. Your mind whispers that you missed something. But here is the truth: very few will tell you missing trades is part of protecting capital. The trader who survives long enough to compound his money is not the one who catches every move. It is the one who avoids the expensive traps that look irresistible in the moment, and the perfect entry is often the most expensive trap of them all. Because it does not look dangerous, it looks inviting, it looks logical, it looks safe, and that is exactly why it works on so many people. The market, you see, has a very particular sense of humor. It gives the crowd what it wants, right before it gives the professionals what they need. So the next time you see that flawless pullback, that immaculate breakout, that setup so clean it practically begs for your order pause, lean back and ask yourself quietly: waiting for confirmation usually costs less than chasing perfection. I learned that lesson the expensive way, and if you have traded long enough, chances are the market has already tried to teach it to you too. You see a setup forming, clean structure, tidy pullback, everything lining up like it came out of a textbook, and right there, a voice in your head starts whispering, "Don't wait, get in now before it runs." That voice has emptied more accounts than bad analysis ever did. You must understand something very clearly. The market does not reward speed for its own sake. It rewards alignment between price, time, and order flow, and that alignment rarely reveals itself at the exact moment a trade looks most attractive to the impatient eye. Have you noticed how often the early entry feels brilliant for a few minutes, and then suddenly feels heavy in your hands? That is no coincidence. When traders chase what appears to be the perfect entry, they are usually acting before the market has finished its business. Price levels that look ready to break are often still being tested. Pullbacks that look complete are often still gathering orders. What appears finished to the crowd is frequently still under construction by stronger hands, and so the impatient trader steps in too soon. Now, the patient operator, the one who has paid his tuition to the market, learns to wait for confirmation, not because he enjoys being late, but because he understands the mathematics of survival. Confirmation is not about being right more often, it is about being wrong less expensively. There is a difference, and it shows up directly in your equity curve. When you wait for confirmation, you may sacrifice a few points of entry. Yes, the trade may move slightly without you. Yes, your entry price may not look as pretty on paper, but what do you gain in exchange? Information. You gain proof that the level actually held. You gain evidence that momentum is truly shifting. You gain clarity about whether the move is attracting follow-through or merely triggering early buyers. Tell me, would you rather enter cheaply with uncertainty or slightly higher with evidence behind you? Most traders answer that question incorrectly, even if they know the right words, because the human mind is wired to fear missing out more than it fears being wrong. That is the trap. The chart looks ready, the candles look strong, and suddenly the trader feels a subtle pressure building in the chest, the fear that the move will leave without him. So he jumps early. But the market is a master of timing. It often gives the early buyer just enough movement to feel validated before it turns back to sweep the level properly. Stops get harvested. Weak conviction gets exposed. And the trader who could have waited for confirmation is now sitting in a loss, wondering what he missed. He didn't miss analysis. He missed patience. You must remember this: the goal is not to buy the bottom tick or sell the top tick. That is vanity, not strategy. The goal is to participate in the middle of a move that has already proven it has strength. In my day, watching the tape hour after hour, I noticed something that never changed. The biggest moves, the ones that truly built fortunes, rarely required perfect entries. They required correct positioning during sustained movement, and sustained movement reveals itself through confirmation. Volume expands, pullbacks become shallow, breaks hold instead of failing. The character of price begins to shift in subtle but observable ways. These are the footprints of real money at work, but you only see them if you give the market time to speak. The trader who is obsessed with perfect entries is usually focused on price alone. The trader who waits for confirmation is watching behavior. He is studying how price reacts at levels, not just where those levels are drawn. That distinction separates the hopeful from the professional. Let me ask you something honestly. How many of your losing trades looked absolutely beautiful right before you entered them? Exactly. Beauty in a chart can be deceptive. What matters is not how clean the setup looks in isolation, but how price behaves after the key level is touched. Does it reject strongly? Does it stall? Does it attract aggressive follow-through? Or does it hesitate like a man unsure of his footing? Confirmation lives in those details. And here is the part most traders resist. Waiting feels uncomfortable. It feels slow. It feels like you are giving up edge. But in truth, you are buying clarity with a slightly worse price. And clarity in this business is cheaper than regret. The disciplined trader makes peace with this trade-off. He knows that missing a few points at entry is a small price to pay for avoiding the full weight of a failed move. He understands that capital preserved today is capital available tomorrow. A breakout everyone sees is rarely the breakout that pays best. I learned that lesson not from books, but from watching the tape take money from confident men. The market has a way of humbling those who believe the obvious move must be the profitable one. If trading were that simple, fortunes would be common and discipline would be unnecessary. But the market is not built to reward the obvious. Think about it for a moment. When a level is so clear that every trader on the screen can see it. The clean resistance line, the textbook consolidation, the perfectly drawn triangle. What do you suppose is happening beneath the surface? Orders are gathering. Buy stops stack above the level. Breakout traders line up with market orders ready. Late shorts place their protective stops in the same neighborhood. Liquidity begins to thicken like fog over water, and where liquidity gathers, stronger money pays attention. You must understand that a widely watched breakout level is not just a technical pattern. It is a map of where the crowd intends to act. The professional operator does not ignore that information. He studies it carefully. Have you ever bought a breakout that looked flawless, only to watch price poke above the level for a few moments before slipping back inside the range? That is the market conducting business. When everyone sees the same breakout, the first move through the level often serves a different purpose than the crowd expects. It is not always the beginning of expansion. Sometimes it is the clearing of inventory, the filling of orders, the triggering of stops, the testing of demand. The impatient trader calls it bad luck. The experienced trader calls it structure. You see, real breakouts, the kind that travel clean and far, often begin in places where participation is still uncertain. They do not always announce themselves with perfect symmetry and textbook geometry. More often, they emerge from areas of doubt, hesitation, and uneven positioning. Why? Because strong trends need imbalance, not agreement. When everyone agrees that a breakout is coming, much of the fuel is already committed. Early buyers have bought, stops are tightly clustered. The market becomes heavy with expectation, and heavy markets do not always move cleanly. Let me ask you something. When you spot a breakout that looks almost too perfect, volume building neatly, resistance tested multiple times, social media buzzing with anticipation, do you ever stop and wonder who is left to buy after the level finally gives way? That question alone will save you money. The crowd tends to believe that the more obvious a level becomes, the stronger the breakout will be. But in many cases, the opposite is true. The more attention a level attracts, the more likely the first break is to encounter friction. Professionals understand this dynamic very well. They know where breakout traders tend to place their entries. They know where stops accumulate. They know how emotional momentum builds as price approaches a widely watched level. And they know how to use it. This does not mean every obvious breakout fails. That would be too simple, and the market rarely deals in absolutes. Some breakouts do run cleanly, especially when backed by genuine institutional demand and strong, broader context. But the trader who blindly trusts every obvious breakout is playing a dangerous game. The key is not to avoid breakouts. It is to read the quality of the break. Does price explode and hold above the level with conviction? Or does it creep above and hesitate like a man testing thin ice? Does volume expand meaningfully, or does it merely spike briefly and fade? Do pullbacks stay shallow and controlled, or does price immediately slip back into the prior range? These are the questions that separate chart readers from chart watchers. In my own operations, I learned to respect the difference between a breakout that attracts continuation and one that simply triggers participation. They can look identical in the moment, especially to the untrained eye, and that is precisely why so many traders get caught. There is also a psychological trap at work here, one that deserves your full attention. When traders see an obvious breakout forming, anticipation builds. The longer price presses against resistance, the stronger the emotional pressure becomes. Traders begin to feel that the move is inevitable. Inevitable is a dangerous word in speculation, because the moment something feels inevitable to the crowd is often the moment risk is quietly increasing. Expectations become crowded. Stops become predictable. Positioning becomes one-sided. And one-sided markets are vulnerable. The disciplined trader learns to slow down precisely when excitement in the crowd begins to speed up. He watches how price behaves after the break, not just before it. He is willing to miss the first thrust if necessary, because he understands something the impatient trader does not. The middle of a real move is far more profitable than the beginning of a false one. Patience, in this business, is not about doing nothing. It is about waiting for the market to prove its intentions with behavior, not just with appearance. The best trades often begin when the chart still feels slightly uncomfortable. That statement may trouble the novice trader, because the natural instinct is to seek clarity, smoothness, and perfect alignment. The human mind craves certainty. It wants the market to look clean before committing capital. But the market, in its quiet wisdom, rarely offers that kind of comfort at the very moment opportunity is ripening. I learned this lesson not from theory, but from watching move after move leave without the crowd. The trades that went on to travel far, the ones that built accounts rather than bruised them, often began when the picture was not yet obvious to everyone. Have you noticed how the cleanest charts often appear only after the move is already well underway? By the time the trend looks beautiful, much of the easy money has already been made. The pullbacks become orderly. The moving averages line up neatly. The structure begins to look like something you could frame on a wall. And right there, just when the chart finally feels comfortable, the risk often begins to increase. Because comfort attracts participation. When a trade feels slightly uncomfortable, it usually means the crowd is still uncertain. Some traders doubt the move. Others are positioned the wrong way. Volume may be building unevenly. Price may be behaving in a way that does not yet look textbook. There is friction in the tape. And friction, my friend, is often where opportunity lives. Now do not misunderstand me. I am not advocating reckless entries or blind guessing. Discomfort must be paired with logic. The professional does not trade confusion. He trades developing clarity. There is a subtle but critical difference between a market that is messy and one that is quietly shifting beneath the surface. The skilled trader learns to recognize that early shift. Perhaps support has just been reclaimed after a long decline, but the candles still look hesitant. Perhaps a range has broken, but follow-through is still modest. Perhaps volume is expanding, yet the structure has not fully smoothed out. These are the moments that feel slightly uneasy. Not wrong, but not obvious either. Let me ask you something honestly. How often have you waited for the chart to look perfect, only to find that by the time it did, your risk to reward had quietly deteriorated? Exactly. When you wait for full comfort, you are often paying a premium for emotional relief. The market charges for certainty. It always has. The earlier you demand proof that everyone can see, the later your entry tends to become. But when you train your eye properly, you begin to notice something fascinating. Real moves tend to leave subtle footprints before they become obvious. The character of price changes first. Then comes the structure. Finally comes the crowd. Most traders reverse that order in their minds. They want the crowd first, the obvious breakout, the clean trend, the perfect alignment. But by then, the move is no longer young. It is mature, and mature moves behave very differently from emerging ones. Emerging moves feel awkward. They wobble a little. They hesitate. They sometimes retest levels in ways that make the inexperienced trader nervous. But underneath that slight discomfort, something important is often happening. Positioning is shifting. Weak hands are getting shaken out. Early participants are establishing positions. Liquidity is being tested and absorbed. The market is preparing, quietly, almost politely, before it begins to travel with conviction. If you only trade what feels perfectly comfortable, you will often arrive after that preparation is complete, and arriving late carries its own risks. You enter closer to exhaustion. Your stops sit in more obvious locations. Your reward potential shrinks while your emotional attachment grows. The trade feels safer, but mathematically, it may be less favorable. The seasoned operator learns to tolerate a measured amount of discomfort. Not chaos, not randomness, but that slight tension that comes when a move is just beginning to reveal its hand. This requires something many traders never fully develop: emotional steadiness. Because when a chart feels slightly uncomfortable, your instincts will question you. Your mind will whisper that maybe you should wait for one more candle, one more confirmation, one more sign that everyone else agrees. But the market does not pay for agreement. It pays for correct positioning ahead of broad recognition. Watch the tape long enough, and you will see it repeatedly. The cleanest trends often begin quietly. The strongest moves often start when sentiment is still divided. The best entries often occur when the chart makes you lean forward just a little, studying more closely, rather than sitting back in complete ease. That leaning forward, that focused attention, is a valuable state for a trader, because it keeps you analytical instead of emotional. Comfort, strange as it sounds, can make traders careless. When everything looks perfect, vigilance drops, position sizes creep up, stops become lazy, confidence rises faster than evidence. But slight discomfort keeps the mind sharp. It forces you to ask better questions. It encourages you to manage risk carefully. It reminds you that the market owes you nothing and must still prove itself after you enter. The crowd seeks certainty. The skilled trader seeks imbalance. That distinction, simple as it sounds, separates the hopeful speculator from the man who lasts in this business. Most traders come to the market looking for comfort. They want confirmation stacked upon confirmation. They want every indicator pointing in the same direction. They want the story to feel complete before they risk their money. It is human nature. But the market does not reward human nature very generously. You see, certainty usually arrives late. By the time a trade feels obvious to the majority, much of the imbalance that drives price has already begun to correct itself. The opportunity that existed when uncertainty was high starts to shrink as participation becomes crowded. Have you ever noticed how confident the crowd becomes near short-term tops and bottoms? It is almost predictable. At the top, the news sounds excellent. The trend looks unstoppable. Breakouts appear clean and convincing. Everyone suddenly agrees the market is strong, and right there, at the peak of comfort, risk is quietly expanding beneath the surface. At the bottom, the opposite occurs. Fear is thick. Charts look broken. Every bounce gets sold. The crowd becomes certain the market is weak. And yet, very often, that is precisely when the imbalance begins to shift in the other direction. The skilled trader learns to watch for this divergence between perception and positioning. Because price does not move on certainty, it moves on pressure. Imbalance is simply pressure that has not yet been fully expressed. It is the condition where one side of the market is more vulnerable than it realizes. It is the moment when positioning is leaning too far one way while price behavior begins to hint the other. That is where the opportunity hides. Now let me ask you something. When you open a chart, are you looking for comfort or are you looking for tension? Most traders, if they are honest, are looking for comfort. They want the smooth trend, the perfect pullback, the clean signal. But the professional operator trains his eye differently. He looks for places where the market feels slightly stretched, slightly crowded, slightly out of balance, because those are the conditions that produce movement. Think about a tightly coiled spring. When it sits relaxed, nothing happens, but when pressure builds unevenly, when tension accumulates, that is when release becomes possible. Markets behave in much the same way. The crowd, however, prefers the relaxed spring. It feels safer. It looks cleaner. It appears more predictable. But predictable to whom? To other traders who are seeing the same thing. And when too many participants see the same easy picture, positioning becomes crowded. Stops cluster. Entries bunch together. The market becomes heavy with agreement. Heavy markets often struggle to move smoothly. The skilled trader learns to step back and ask a different question. Not, does this look certain? But rather, where is the market most off balance right now? That question shifts your entire perspective. Instead of chasing obvious breakouts, you begin studying failed moves. Instead of buying strength blindly, you watch how price behaves after strength appears. Instead of reacting to headlines or indicators alone, you observe how participants are likely positioned relative to current price. This is not guessing, it is reading behavior. For example, when price repeatedly tests a level but fails to break cleanly despite heavy attention, something is happening beneath the surface. Either strong hands are absorbing orders, or the crowd is leaning too aggressively in one direction. Both situations create potential imbalance, but you only see it if you are looking for tension rather than comfort. Another sign of imbalance appears when momentum shifts subtly before the crowd notices. Perhaps pullbacks start holding higher. Perhaps selling pressure begins to weaken despite bearish sentiment. Perhaps volume expands on moves the crowd is still doubting. These are early signals, not guarantees, that positioning may be uneven, and uneven positioning is the raw material of profitable trades. The difficulty, of course, is psychological. Trading imbalance often feels less comfortable than trading certainty. You may enter while opinions are still divided. You may take positions before the chart looks perfect. You may feel early rather than perfectly timed. That discomfort is part of the business. In my experience, the trader who cannot tolerate measured uncertainty will forever be late to the most efficient opportunities. He will wait for full agreement, full confirmation, full clarity, and by the time he receives it, the easy part of the move will often be behind him. But the trader who trains himself to recognize imbalance develops a different kind of patience. He does not rush blindly, but he does not require universal agreement either. He watches how price behaves around key areas. He studies where the crowd is likely leaning too heavily. He respects risk at all times, but he does not demand perfect comfort before acting. And over time, that mindset changes everything about how you see the market. You stop asking, is this certain?